Hello everyone, and welcome back to the Central Arizona VITA Network's presentation of their 2021 VITA Tax Law Training. In this session, we are going to review the Affordable Care Act, some miscellaneous forms and other taxes, and then dive into the Arizona tax return. So let's get started.
Okay, we're going to do the Affordable Care Act. We're going to cover some miscellaneous forms and some other taxes. But the heart of session 5 is Arizona. We're almost done with the federal section of the return. And the test that we take in the advanced certification test only has questions about, as we covered this morning, those 35 questions are all about federal taxes. So the rest of this part on Arizona exclusions and credits, this is stuff you're going to need to do or need to know when you do a tax return, because everyone that we see is going to have to do an Arizona return. Health insurance. So the Affordable Care Act, known as Obamacare, can have an effect on a taxpayer's return if they purchased health insurance through the marketplace. If they purchased health insurance through the marketplace. There's 3 forms, 1095A, B, and C. You'll see a C, you'll see a B, the taxpayers will bring it in. It's only when you see a 1095A that we need to do anything in the software. And so the question that you see in TaxSlayer is, did you purchase health insurance? If you mark yes, yeah, we have stuff to do. But if you mark no, you hit continue and the software moves right on to the state section. But if you've marked yes, they got it through healthcare.gov, then the screens are going to change. You're going to then get a screen that says, make sure these are all the people in your household. And so they might list 2 or 3 of them. What they're interested there is, do any of them, did they bring any additional income into the house? We don't see that screen very often. If you mark yes, then you get a couple of questions. The first question is, are you required to pay all of the advance premium? Most of the time, we just say no. Then do all forms of the 1095 include coverage for January through December with no changes? You mark yes. And that's great, because then these 3 boxes appear, and these are the totals that occur at the bottom. Notice that it'll say like form 1095A, line 33B, line 33C. Well, there's a whole mess of lines above that with individual information for each month of the year. These are the 3 boxes that are the totals at the bottom of form 1095A. So if you've marked yes up here, you're saying, hey, all the monthly totals are the same. Then they just want the totals for the year. Then you would mark continue to go on. But if you mark no, they're different. Oh, now you have to do some typing, because now they're going to show you the form and they're going to say, okay, you're going to have to put in the amount. Maybe they didn't have coverage in January, February, March, April, or May. Maybe in June, they started getting coverage. And then there's going to be 3 blocks that you're going to have to type in. And then you're going to have to type in the next 3 blocks and the next 3 blocks, going all the way down the page. What we're talking about is that the Affordable Care Act, we use a process called reconciliation. Reconciliation means that if you used more advance payments than you qualified for based on your final yearly income, you have to repay the difference when you file your federal income tax. So let's go back. You're shopping for health insurance and you tell the federal government, I think I'm going to make $30,000 this year. Well, now that and then they say, based on 30,000, here's how much premiums we're going to give you to pay down the cost of your health insurance, so you don't have to pay as much. Those premiums that they're giving you are based on your estimate of your taxable income for the year. So you said, I think I'm going to make 30,000. Well, now we're doing your taxes. And we've actually put the amount in that you earned in the year of 2021. So now the government knows this is what you actually made. So if you made more than what you estimated, you're going to have a difference. So you're going to have to repay some of the difference when you file your federal income tax. But if you used less, you estimated that your income was going to be $30,000, but you only made $25,000, then you're going to get, the government's going to say, oh, we owe you a little bit more. And so you're actually going to get a credit for that difference when you file your return. But that's the process of reconciliation. It's because it's based on when you apply for Affordable Care Act coverage, you're estimating your income. And now when you complete your tax return, now we know what your actual income was. So then we make that adjustment or reconciliation. So let's take a look for an example. I had a return. I created a fake return. And notice up in the upper right-hand corner, they have a federal, the software has calculated the refund at $1,701. Well, I typed in, oh yeah, up here, do all your forms for January through December have no changes? And I clicked yes. And then I put in, just randomly, I chose $1,000 and I put it in each block. So then I hit continue. And then it says, oh, your return is complete. But notice what it did immediately upon hitting the continue button. It recalculated the return. And so all of a sudden, they're getting less of a refund because apparently their estimate of their income was a little low compared to their actual earnings. And it took us right on to the federal return, and we're ready to add the state return. So that's how the Affordable Care Act works. Any questions at this point? There's a question. Has your identity been stolen or been committed fraud, et cetera? Have you reported this to IRS? I've forgotten how the question reads, but it's right there on the first set of questions, right underneath the personal information about your address and birth date. The IRS, if you clicked on that and told the IRS, yes, my identity's been stolen, the IRS will write you a letter every year in January, and they'll say, here is a 6-digit PIN number that you must use on your tax return in order for us to know it's you. And they'll do that for 5 years. And you have to have that each year, otherwise your return gets rejected. Now, sometime in early 2021, the IRS opened up the IRS identification theft PIN process to anybody. You can go to an irs.gov website and there's a link that you can click on and you can ask them, set up your identity protection theft PIN so that you get one, but you'll get one every year for longer than 5 years. But then there's also a link that says you want to go back to the IRS and tell them, I opt out of it. I don't want to receive an IRS identity PIN anymore. But if you get a client who has one, then this is where you're going to begin. The installment agreements, I've not done one. The application for ITINs, I did one and it's really complicated. It takes in all of their documents. And we'll probably cover it a little bit, but I just want to move on. I have not done anything with a power of attorney. That just doesn't happen very often. Now, injured spouse, you're considered injured if the IRS can keep your tax refund because you're legally enforceable past due financial obligations of a spouse. If your spouse has past due financial obligations, the IRS will come in and take your refund unless you file an injured spouse return. Now, I'll tell you right now, I don't know how I lucked out in doing this, but I've seen 3 or 4 of these in the 8 years that I've been doing this. But each time I've seen these, I've been able to convince my wife to do the tax return. So I've never actually had to do one of these. Woohoo! Here's the application for extension. Here's the 2 screenshots. Just remember that when you plug in these amounts, you also have to pay the IRS the amount that we think is due, so that it just allows them more time to get their documents together and get things in order. So the extension has to be filed by the 15th of April, or in this case, I think it'll be the 18th And then it extends until October. Normally it's the 15th, but it's fairly simple to do. It's just a couple of blocks that you fill in. Now, here's the IRS Identity Protection Pin, where you would plug in the number for everybody on the return. And of course, it'll get rejected if you didn't do that, if they had a PIN last year. If the taxpayer is already on a payment plan, we will not be able to fill in this form that's needed for requesting an installment plan. So you submit the tax return without the form. Taxpayer is going to get contacted by the IRS. They're going to have to set up a new plan. I'm trying to think. I don't think I've had to deal with this. I've had a couple of people who have said, I don't have the money to pay this, but I've not been around when they had their letters with the IRS and then they set up their installment plan.
Yeah, the IRS, I might jump in just for a second, because I've had a bit of experience with these. And what I'll tell a taxpayer is, if you know you need to set it up and you know how much you can pay, and also with this, they can't stretch this out over 20 years. I think it's got to be paid off within 5. But we can set up the plan for them. Otherwise, most of the time, these taxpayers, it's hitting them by surprise that they're going to owe this. They don't really know what they can afford to pay. They don't know. And I say, let's just file the return. They're going to send you a letter saying, hey, you owe this amount of money. And they give you all the information of who to call or how to go online and set up the payment plan. And then you can have time to kind of arrange it. So that's usually what I tell them.
Excellent. Thank you, Jim. So here's a screenshot for the installment agreement request to plug in the information. Again, to me, it's pretty straightforward. You're going to put in their personal information, their address, their employer information, and hit continue. Now the ITINs, which this is an application, in other words, they need to renew it, and that's a Form W-7. So we told you about the middle digits that were being replaced. I think these digits have all been taken care of, but some of them may still show up at the end of 2021. So to my mind, I'm thinking, okay, if they're in the 90s, let's worry about it. But if they're not in the 90s, then they're probably fine. But then the forms for the W-7 are attached to the tax return. And there's a website that you can go to check out which documents have to be attached to the tax return. And if anybody's applying an ITIN, then it becomes a paper file. So you're just going to have to print out 2 copies, one for the client to keep and one for them to mail in. And the site coordinators can assist you with that. And if you run across that, or you got somebody with an ITIN number that needs to be, that has to be renewed, I'd go ahead and just get the site coordinator. It takes up some time. I would say probably an extra half hour to an hour of getting all the forms together. The thing is, the client can mail their W-7 and their tax return and their original documents or their copies that were certified to the IRS, or they can visit an IRS walk-in clinic, or they can go to an ITIN acceptance agent. This is going to delay their return by months. But the key here is that there are 2 things that they can do. If you visit the IRS walk-in clinic, there are 4 IRS offices in the Valley of the Sun. And you make a call, you make an appointment, you go in and you show them the documents you have proving your identity. If they're happy with that, they certify them right there. They do it for free. If you go to an ITIN acceptance agent, they are not part of the federal government. They are a private entity, a corporate business. They're providing this service for a fee, and so they can charge you. If you look at that website to get a list and you check Arizona, and then you check near me, they'll bring up a list of 30 or 40 different ITIN acceptance agents. And as you scroll through, you're going to see that the prices vary all over the place. I clicked on a few of them. The one that I remember the most is they charged $100 to fill out the W-7 form online, which is what I could do as a VITA volunteer. But then they charged like $200 more to be the acceptance agent, where they certified that those documents were correct. So it's up to the client. I always tell them, well, I haven't told, it's not always, I've only dealt with it one or two times. I always say, your best bet, go to the IRS. It's done for free there.
One other option too, and it's not necessarily easy, but they can go to their consulate and get certified copies that are okay. The problem is some consulates are in Los Angeles or San Francisco, but there's a few in Phoenix, but that's another free way that they could do it too.
Right.
We don't see many of these, and so I wouldn't stress out about this.
Yeah, and the key here is if you see one, get your site coordinator involved. Actually, I doubt you would, because most site coordinators, when they see the returns, the screener will tell the site coordinator, oh, I've got a W-7 that needs to be renewed, an I-10 that needs to be renewed. Most of the time, the site coordinator will route that to one of the more experienced ones. Again, we were talking about 4 to 6 weeks for processing the return and the receipt of the I-10 letter. That was in 2019 and 18. But since COVID hit and the IRS has gone remote, it's taking months to do this. But we always have to tell our client, hey, you're not going to get a tax refund until the I-10 application is processed. So don't be counting on that in the next 10 days. So here's the tax layer screenshots. You've got applicant information, personal information, the identification submitted. Then you've got to fill out the forms under each of those submenus. But again, you're filling in the boxes with the information. Every time you hit continue, it saves the return and moves to other taxes that we run into are self-employment, tax on unreported tip income, a tax on early distribution, and the first-time homebuyer repayment. Now, the first-time homebuyer repayment, I see almost every year. I have 2 or 3 clients who come back to Paradise Valley Community College every year, and they're well aware that in 2008, they got their first-time homebuyer credit. It was actually, it wasn't a credit, it's a loan. The federal government loaned them $7,500. And they're going to pay $500 back every year for 15 years. Well, that's 2008. So the 15 years ends in 2023. So I think 2022 will be the last year that they have to make a repayment. And so it just shows up as a first-time home buyer repayment, $500, as added to their tax bill. It's real easy to do. But those are the only ones I've seen. I haven't, at any other sites I've volunteered at, I've never seen one of those. The self-employment tax, that's always a shock to some of the self-employed people because they're filling out the information and they forget about what percent was taken out of the income for Social Security tax and Medicare tax. Now, the nice thing is it's always auto-calculated. I don't have to do any of the math. As long as I put in my information in Schedule C, that pops up. Tax layer software will take care of that. But 1/2 of the self-employment tax is automatically carried to Schedule 1 as an adjustment to income. I think this was Congress attempting to help self-employed people out. As an individual, when I would go to work, I took, 7.5%, Jim?
Yeah, it's 7.65% combined Social Security and Medicare.
So I took that amount out of my salary to go in to pay, but my employer took the same amount and contributed to my retirement, to my Social Security payment and my Medicare payment. So that's like what, 15.3%, something like that?
Yes.
So that's being deducted from my wage, from my income. However, if I'm self-employed, I have to take the 7.65, but I don't have an employer except for myself. So I'm actually going to be contributing the 15% to my Medicare and Social Security funds. Well, the federal government said, it's kind of unfair that people who are employed with an employer the employer has to pay half of it, but if they're self-employed, they have to pay all of it. So here's the deal. we'll take half of that self-employment tax and we'll put it on Schedule 1 as an adjustment to income. It'll lower your gross income by half of your self-employment tax. So you'll see your self-employment tax listed in two different places on the 1040 form.
And the other rationale for that, if you think about it, is your employer gets to take a deduction for their contribution to your retirement. And so Congress said, well, since you're your own employer, we're going to give you a deduction, although they call it, it's an adjustment now, but it functions the same way. We're going to give you that same deduction for 1/2 of what you paid, which is similar to what the employer would do.
Okay. Now, this next screen talks about the CARES Act. We did in 2020, they allowed 50% deferral of the employer's share of the self-employment tax. So if the income, it was only for the income earned between March 27th and the end of the year. Some clients elected to defer that. In other words, it meant that when they filed their 2020 tax return, it was a rough year. They didn't have to pay as much self-employment tax. The problem is it's a deferral. It just means they have to pay it back. They still have to pay it. It's not forgiven. So 50% has to be paid in 2021 and the other 50% in 2022. So if they're self-employed in 2021, they're going to have self-employment tax on their income from 2021 plus 50% of their self-employment tax added to that from the previous year. So we may have some payments due there. Now, this is the tax on early distribution. We talked about this before when we were talking about the 1099Rs. They're going to have that additional tax if they took it out before they were 59.5, and it's not rolled over into another qualified plan, and if there's no other exception that applies. And we talked about those exceptions and where you can find those. I don't think we need to worry about this one because most of our clients, well, I take it back. You might have a client who's taken out penalty-free from their 401k that's without being subject to the 10% penalty. And that was extended. So you might have a client who comes in and says, I took my penalty, I took my distribution in March or April. The penalty-free distribution could go up through June 25th. Again, we don't know how TaxSlayer is going to recognize that so that we have something to input. But when our client shows us their 2020 return, it will show the distribution they took. So we'll know to look for it at that point. And here's that tax on early distribution auto calculation, the form. This pops up on the screen and you just select whichever one you want. Notice there's nothing in there that says COVID. COVID is an other. Now that's last year's screen. So maybe this year it'll say COVID. I don't know. I haven't seen it yet. So far, everything in TaxSlayer has been based on last year's screens. And the distribution, the withdrawal of a pension plan can be done without penalty if certain conditions are met, but the income is still taxable, but it can be spread over 3 years. So what happens is you go into the tax on early distribution under the other taxes menu, and you click on edit. And then it takes you over to the early distributions that are not subject to your 10% tax. And you go down to, then you click on the box, select the reason for exemption, and then the reasons pop up, and you click other. And when you click other, it takes you, it goes right to continue. Now, I think this year that other is going to be changed to COVID related, but I'm not sure because we haven't seen the new screens yet. Hopefully in the next week or two. First-time home buyer credit, we already talked about that. It's a no interest loan. It has to be paid back and they're going to pay back $500 each year for either 15 or 16 years. There are some situations where maybe they sold the house and they may have to pay back a portion of the credit, or they may, when they sold the house, they may have paid off the credit during the sale of the house. If that's the case, get your site coordinator, because that requires, I think, a couple other screens. More verbiage. Here's the screenshots for it. What to plug in. But it walks you right through it. Which taxpayer it is, how much, and the amount is automatic. It's 500. They don't get an option. It's always 500. So it just flows through. And now we're at the state section. Jim, how about if I go ahead and just continue on with the state section, and at lunch, when we come back, if I don't get a chance to finish it up, the Arizona Native Americans concerns were in yesterday's session, and we didn't get to them, but they fit with Arizona. How about if we tack those on at the end?
You bet. I would like to mention one thing about the exception to the early withdrawal penalties is we didn't show you a slide of it, but if you look in your 4012 under, help me out here, Gene, is it under other taxes? Yeah, it's under other taxes, and it'll show the 10% penalty on early distribution. There's a chart in there that shows all of the exceptions to the 10% penalty. The common ones are to pay for educational expenses. If you take withdrawals to pay for educational expenses, you don't have to pay the 10% penalty. You still have to pay the tax on it because you never pay tax on that money. Similarly, there's an exception for first-time home buyers. Those are the two common ones that you'll see. But I really wanted to point that out because one of your test questions talks about the 10% penalty on early distributions. And I want you to be able to go find those exceptions.
Great. Okay. So once you've completed over here in the left hand, you've done all the basic information. You've completed the whole federal section. We've covered the health insurance. The computer now says, hey, we're at the state. We're ready to do the state section. Now, at this point in your practice lab, it says, sorry, states aren't loaded. So hopefully by the first week in January, they will be there. But the tax layer works with the IRS, and they work to make sure the federal form is done first and completed and working right before they start loading the individual states. So when you get the screen for the state section, here it is. We're going to click here to add the state return. And then you have a choice. You can either use the drop-down menu, or you can come over here and actually click on the icon of the state of Arizona. Either one will start the Arizona return. Then you go down and click on continue. The next screen shows you your choice of resident, part year, or non-resident. Last year, the city of Phoenix said it's out of scope for us to do part year and non-resident. I'm not quite sure. I haven't heard anything yet this year. Most of our clients, I think 98% of them, are going to be residents. However, if there's someone who moved into our state during the year, well, then they're a part year resident. So they might have come from California to Arizona, or Michigan to Arizona, or Georgia to Arizona. I had my first or second year, I had a gal come in from Georgia, partial year. I'd never done one before. And the site coordinator sat down with me and said, look, you're not trained on Georgia, but the software will do Georgia. So we sat and we talked with the client and said, I can't tell you if it's done correctly or not. I'm going to plug in the information in the federal, and the software will automatically flow it in and fix everything that it thinks is appropriate for Georgia. I worked for a couple of hours making sure everything went right, and we printed out copies and everything. That evening, I got an email from the site coordinator. The return had been rejected. somebody else had already filed under that Social Security number. Oh my goodness. So you just never know. Most of our clients, go ahead.
The thing I would add to that is IRS gives us discretion on whether to do multi-state returns or part year returns. But, you know, what they, you know, when I started that, my IRS representative said, this is up to your judgment. So the first thing, whenever you see something like that, they say, oh yeah, well, I just moved in here in March. Get your site coordinator involved. I think City of Phoenix has more rigid rules, but some of you are here from other organizations, a New Leaf or Masters of Coin or whatever. And if you ask the site coordinator first, we may or may not do the returns. Some of them are pretty simple that you can do. Others, like I'll tell you, New York, when you do a New York return, there's like 5 returns in there. There's the borough and the city and the county and the state, you know, and unless you've got experience doing those, you don't really want to mess with those.
Yeah, we had, I also volunteer with ARP, and at our site, we have a guy who has done California returns for a number of years before he moved here. And we have a gal who lived in Illinois, and she did ARP returns in Illinois for a number of years. So they're both working with us in Arizona. So if we've got a part year resident from Arizona and they move from California, I've got an expert who's right there to, you know, I can ask them to come over and help me and explain to the client what the return is. But most of the time, I just have to tell the client, I'm not trained in anything except Arizona. So I don't have a clue if it's done right or wrong. Do you want to proceed, or do you want to go find somebody, a professional who will be able to help you? And that leaves it up to the client. But then right after you've marked it full year or part year, you get to the basic information page. And Arizona is going to want to ask you a couple of questions. Most of the time it's, is this your first time filing an Arizona return? No or yes. I haven't ever seen anybody enclosing a payment or filing under an extension. Doesn't mean it wouldn't happen. There are 2 questions at the bottom that deal with qualifying parents or ancestors that were claimed on a federal return or were not claimed on a federal return, but are eligible for Arizona purposes. And we'll cover those 2 instances in a little bit. Then it takes you to this menu. And these are the most common menus used by VITA. Basic information, subtractions from information, and credits. Those are the ones we run into, I would say, got to be in excess of 90% of the time. Arizona allows a $2,300 exemption for each person 65 years of age or older. So once you've determined, the Arizona starts with the adjusted gross income from the federal government, and then they do some subtractions or additions, and they come up with, here's the taxable income, and then they allow you to take for the deductions an exemption. So you still get the standard deduction or an itemized deduction, but they also give you a $2,300 exemption if you're over the age of 65. And there's another exemption for $2,300 for stillbirth. Let's see, what else can I tell you about that? Oh, there are some specific rules concerning the $2,300 exemption for each person over 65. Those are there in the 2 bullets on your screen. Most of the time, I have never dealt with those because the software seems to take care of the calculation based on what I entered in the federal return. Has to be the parent or grandparent of the taxpayer, must be 65 or older, must live in the taxpayer's principal residence, and must be a qualified dependent of the taxpayer on their federal return. And they must have required assistance with 2 or more categories of activities of daily living, like one of those or 2 of those items. And that's possible because we have some parents who are living with their children, and their children help them dress and eat and walk and bathe and take their medications, etc. If you see a parent or a grandparent on the taxpayer's federal return, be sure to determine if they may be a qualifying parent or grandparent. They will be removed as a dependent on the Arizona return, and the taxpayer will receive an exemption of $10,000 instead of $2,300. And that's those two buttons down there at the bottom of the page on the basic information page. So you can, if they were claimed on the federal, or if they were not claimed on the federal, that's where you begin. But it's that idea of a parent or ancestor above the taxpayer in a family tree that had help, had to live with the person, with the taxpayer for the year in their home, and had to receive help doing two of those daily activities. And if that's the case, and I have not seen any at this point, but that doesn't mean that they're not there. But if that was the case, then the exemption would become $10,000.
I think it's important, you know, yes, you don't see many of it, but there's not a question on the intake and interview sheet that asks about those kinds of things. And, you know, a lot of times I don't think people think to volunteer that information. So if you see that they've got a parent on their return, parent or grandparent for that matter, it's probably good to ask something about, you know, are you caring for them or whatever? There's a special, it's a pretty valuable exemption. I mean, you know, that can be worth a couple $100 to somebody easily. You know, but it's a, pardon me?
Go ahead.
No, it's a touchy situation. You've got to kind of ask it, you know, delicately. I know my mom lived with me, and well, they used to have a credit on that, and I used to take that credit every year. But so I think it's out there more than we know.
You're probably right on that. I was going to say that the with ARP for the state of Arizona, because of this, as at ARP, we have the standard intake screening form that VITA uses, but we add a page to it. And the page is only for those things in Arizona that would require me as a volunteer to do something in the Arizona part of the tax return. And so that's one of the questions that occurs in there. And then it provides the information about, so that we can actually screen the client. So they fill out the intake form, and then there's the Arizona intake form with it. And that helps me as a volunteer preparer know what things I need to do when I get into the Arizona return.
Right. And we're getting a couple questions on this. Could you back up to that slide that talks about the requirements? One more, go, one more. Okay. Okay. So there was some questions about this versus that ancestors exemption we just talked about. So here's the first one. There are two different ones. This is a $2,300 exemption for each person 65 years of age or older, regardless of the relationship. However, you had to pay more than a quarter of the total cost of maintaining that person in an Arizona nursing care institution. And then there's more, residential care institution, and the payments had to exceed $800 in the tax year. It has to be more than a quarter of the total cost, and they had to exceed $800. Then you get an additional $2,300 exemption for that person. Now go down one slide. And now this is different. This is the qualifying parents and grandparents, or they call it ancestors. That sounds kind of crude. I don't know. Ancestors, but never. This is a separate one. This is for the $10,000 exemption. And they have to be 65. They've got to live with you, and you've got to take care of them. That's really what it amounts to. So this is the extra $10,000. The $10,000 exemption is when you're taking care of somebody. So a couple people have posted questions that were confused about those. So hopefully that cleared it up.
Oops. Okay, so we're back here. So the next one is, Arizona will not tax the first $2,500 of a pension if that person has done something to earn that pension, that's part of their list. Now, when we say that they'll not tax the first $2,500, if their pension for the year is only $1,900, they don't get the $2,500. They only get $1,900. If their pension was $30,000, they only get $2,500. And you can, the way the software works, you can type in 2,500, it'll exclude it. You can type in the total amount of the pension and it'll do the calculation for you. But it's only available if the person worked in public government, U.S. government retirement, the Arizona State Retirement System, correction officers, public safety, elected official retirement, a retirement plan for schools, counties, cities, or towns in Arizona. You could be a librarian. You could be a post office worker. You could be a teacher. These all fit. So if you were in public employment, that $2,500 pension exclusion is there. The problem is, even though tax slayer takes all that information in the federal return and flows it over into the state return, it doesn't do this. It will ask you, let's see, I think I've got a screen in here. I'll come back to that. Subtractions from income, begin. Yes. And then tax slayer now says, you have a pension that might qualify for an exclusion. Do you want to? Yes or no? And if you say yes, then it takes you to this screen and you can enter the exclusion for U.S. government, Arizona state, local government pensions. So that would be this part up here. So you could put in the 2,500 and it could be for both if you were married filing jointly or just the taxpayer. Now, this next exclusion is for retired retainer pay of uniformed services. I'm going to talk about that. I'm going to back up and we'll show you those two screens. And then later on, we're going to cover American Indians because we can exclude some wages of American Indians. The software doesn't do it for us automatically. We have to do it. So these three screens are for us to input. And we do see most of them are these two. Occasionally, depending on your location, you might see this one. So let me back up. This was the U.S. government, Arizona state, local government pensions, the $2,500 exemption. Now let me back up and let's deal with the uniform services. Last year, the state of Arizona would, 2 years ago, the state of Arizona said, uniform services, you get to have $2,500, the first $2,500 of your pension, excluded from income. Last year, they made it $3,500. So we typed in $3,500. This year, for 2021, all of it is excluded, but only if the person served in the U.S. Armed Forces or the Corps of Public Health Service or the Corps of the National Oceanic Atmospheric Administration. And under U.S. Armed Forces, don't forget, that includes the Coast Guard. Again, it goes under subtractions from income. Yeah, I think you might have a possibility. Do you want to use it? If you said no, you go on to the next screen. But if you said yes, it would take you to this screen. And you would place it here. And you would have to put the total amount on that pension. Okay, total amount. That's a big change for this year. From $3,500 to exclude to all of it.
I will just mention, you will see quite a few, like I'm a retiree of ASRS, the Arizona State Retirement System. That's for teachers and stuff. And we do still see quite a few of them. And we used to miss some of them. And that's TaxSlayer. I think we had asked somebody had asked TaxSlayer to put up that warning screen because we found doing quality reviews and stuff, we would miss those a lot.
Oh, I had a client, I would say my second or third year, who came in and she was divorced from an Air Force pilot. But in the divorce paper, she showed it to me, she gets his pension. So I said, well, then we can put in this $2,500 exclusion. And she went, what? I've never had that. So we plugged it in, figured it out. And then I said, you know, you could probably go back and amend last year's or the year before, but we can't do it now during the regular tax filing season. Sure enough, she showed up in June. I want to do my amendments. So she brought all the tax forms and stuff. We went back in. One year, I know she got like $400 or $500 refund because we plugged that in that had not been plugged in before. So I'm kind of hoping that she shows up again this year and I get to say, whoo, all of it's excluded. She'll be really happy. All right, next up we have credits. And here the screen shows these are the most common credits that we use, that we see. The property tax credit. And for property tax credit, people, they will be lined up the first day we open. Because if you're a senior citizen, age 65 or over, and you're living on just Social Security, you have absolutely no income from the state of Arizona that's going to be taxed, because Arizona will not tax any Social Security amount. So as far as the state of Arizona is concerned, you have zero income, which automatically qualifies you for up to $502 of the Arizona property tax credit. Those people know that, and they're there to make sure it gets filed the first day we're open because they want that refund mighty quick. Then the credits for charitable organizations, public school fees, school tuition organizations. I think under charitable organizations, we now have foster care organizations as a group in there. So those are the screens that we see the most often. Now I mentioned that a senior who's living on Social Security doesn't have much income. And a lot of seniors have been told, you know, you don't really need to file because there's nothing, when you do the tax return, the federal form says you don't have enough income to have any withholding. You didn't have any standard deduction because you didn't have any income. It was just Social Security. We didn't tax it. And so you have $0 tax, $0 owed, and $0 refund. And the IRS computers don't like to mess with that. It takes up time for the computer to calculate all that in a second. But you've got a lot of seniors, millions of seniors who fit into that category. So the IRS said, you know, we're going to just reject your return. So if you've got someone over 65 and their return comes out and you look at their summary print page and it shows $0 owed and $0 refund, you're probably going to look at a rejected return. Well, we tell people, you know, you really need to file a return because first off, it's going to tie your Social Security number to a tax return. That means your Social Security number is not out there eligible to be picked up by some nefarious, corrupt person who files a fake return. Secondly, we want to do this because we want to conform with the Maricopa County VITA network so that we're doing all the same services throughout the county. But it's primarily because of that ability to claim a freeze on Arizona property tax rates. If you're over 65, each year, your property, the property tax rate goes up a little bit, but you're on a fixed income. And sometimes Social Security doesn't keep up with the cost of living, even though they give you a cost of living increase every year. And so the property tax rate can become a burden for senior citizens. So Maricopa County, the state of Arizona, said, we'll freeze your property tax rate. We'll keep it the same. But in order to do that, you have to submit 3 years of federal returns. So you really need to file if you're going to get the benefit of having a frozen property tax rate. The nice thing about the property tax credit is now it can all be e-filed. When I started, it had to be a paper file. You don't have to submit the supporting documents when it's e-filed. And the taxpayer looks at the age of either taxpayer. And the Arizona 201 form, that's for renters. That data, we pipe that into the software. So in order to qualify for the Arizona property tax credit, you have to be 65 by 12/31. You have to have been a resident the entire year. You have to pay property taxes or rent on your main home. And your household income has to be below $37.51 if you live alone, or $55.01. Now, for a lot of seniors who are living on Social Security, maybe they're a Walmart greeter one day a week. Maybe they've got a little pension. As long as it's below those two limits, they're going to qualify for the return, for the credit. But as again, I talked about, if I live on my Social Security, which is not taxed, so my adjusted gross income is zero, my federal refund is zero, my Arizona refund is only $25. How come my federal return was rejected? Well, it's because the IRS rejects any return where it's 0, 0, 0. So we cheat. We trick the computer at the IRS, and we put in $2 as other income, and the description is e-filing purposes. So here's how we do it. On the income menu, you scroll all the way down to the bottom of the menu to other income. You click on begin and then continue. And then you have less common income, other income not reported elsewhere. You click on begin. And there's that description box. You type in for e-filing purposes, and then you put a 2 in the amount of other income. And then you hit continue. And that forces the IRS computer to accept and process the return. It hasn't changed their tax information at all. They're still getting 0 adjusted gross income. They're still getting, there's 0 tax owed, there's 0 refund, but they're now having it filed, and now it goes from the IRS to the state of Arizona. A lot of clients will come in and they'll give us this sample. We've shown you this in a previous slide where it shows the parcel number up here. But this is a bill. This is not what was paid during the year, because Arizona does its property tax payments a little differently. Your property taxes paid in 2021. In May, you paid your July through December 2020 amount. And in October, you paid your January through June of 2021. You're a half year out of sync with the federal calendar year. So what we need is the tax receipt that shows what was paid in 2021. And there's a way to get that online on your computer. All you have to do, if you don't know the parcel number, remember this is where the parcel number was up here in the top of the bill. So if you know it, that's the important thing to do. But if they don't bring that and you think they might qualify for it, there's a way to get that. You would go to the assessor.maricopa.gov and type in the search of the address to get the parcel number. And then you would go to the treasurer, plug in the parcel number to get the tax receipt. So here is the assessor's office. And you would type in up here in the search box, the address. So it says, yeah, we typed in 10 West Georgia, apartment number 23. Oops, let me back up here. 23. And then down here, it shows the result. Here's the parcel number. Tells you the name of the person owning the property and their address and their subdivision, etc. But that's the parcel number. And all you have to do is click on it. And it will then take you to the treasurer's office. Now, if you know the parcel number, you can skip that step and go straight to the treasurer's office. And in the treasurer's office, you're going to plug in the parcel number. Then you're going to scroll down and you're going to click on the tax, you're going to click on, select view your tax bill. And then you're going to click on tax information. And then you're going to scroll down, you're going to click on tax receipt. And it's going to show you, after you've click on tax receipt, it's actually going to print this page out, show you this page. And this person actually paid between January 1st and December 31st of 2020. That's the calendar year we were working on in 20s. It will actually show the total payments made for their property taxes. Then you click on print tax receipt. You print the receipt. We add a return note in the software and enter the parcel number. I print the receipt and I put it with their tax documents so that they have a copy with them. When next year, when they come in with their previous year's envelope, it'll be there. But in addition to that, there will also be that note in the software that has the parcel number and the tax amount on the intake sheet, so that the next year's tax return preparer will have that information available. Remember to do that, to do it, add a note. You go up to the name of the taxpayer at the top of the screen. You click on the little caret. You move down to notes, click on notes. It creates this screen where you get to type in the title. We put in tax year 2021, TY 2021, Arizona Property Tax Credit, AZPTC. Down here, we put in the parcel number, etc. This is where we type it, and you'll see the information printed over here so you can see everything that you wrote. In my case, sometimes it's misspelled, etc. I want to go back and check. It's a good way to do that. So that's where we get the information, but we haven't entered the information into the software yet. So we go back to the credits menu. We click on begin up here at the top. And it takes us to this page. And this is the part that goofs up a lot of people. There's a first question right at the top. In order to use the credit, you have to select yes. It's either a yes, no. If you don't select yes, everything you enter, the software doesn't do anything with. It just ignores it. It's like you walk into a room and you have to turn on the light switch in order to see what's going on. So if you don't mark yes, you're up a creek. Believe me, I have done this. I have entered all this stuff into the software and couldn't figure out why I wasn't getting an Arizona property tax credit for the client. When I went back and looked, oh yeah, I hadn't changed this to yes. As soon as I did and clicked continue, boom, everything loaded. Then you want to do the qualifying questions next. Then you either want to do taxes from Form 201, that's if they're a renter, or if they own, we start with this one. We always start with qualifying questions first. There are some qualifying questions, and you click yes, then you go to the edit box, and then these drop-down menus appear. Were you a resident? Did you own or rent? Did you pay property taxes? Did you live alone? Is this the only property tax being filed for your household? Did you receive Title 16 Social Security disability payments? Now, if this question is yes, we have to have a paper copy, a letter from the IRS, from Social Security, indicating that they received Social Security disability payments. I had one of these, and the gal had the stuff from the previous year, but she didn't have the current letter. And so I said, I can't go any farther. So we just saved her return. She went to lunch. She went to the Social Security office. She got it printed out. She came back after lunch, showed me the letter. We continued. So that's the only case where you really have to, where things can come to a grinding halt. However, most people who are getting Social Security disability payments, they know about it. They're bringing the material with them. They're prepared.
And I believe we have to attach a PDF of that, scan it in and attach it, or have them paper file it. I'm not sure because I haven't done one of those, but is that true, Gene, or not?
They're all paper filed, but
yeah.
I haven't scanned. But you know, the last 2 years with COVID, we've been scanning more and more documents. That may be something that Arizona will accept now.
I think it is, my memory, but we've got to show proof with the return.
Yeah. Good. So now we've answered the qualifying questions. So now we're down to, okay, did they rent or did they own and pay the property tax? So we're going to take the case of they're renting, because they're going to bring in this Form 201. And that's provided, say you're renting an apartment. Your apartment manager has these from the landlord or from the property management service. They have a stack of these. They're just photocopies. They filled out the Form 201 for Arizona. They made copies of it. They're sitting there in the manager's office. Some people, you have to go to the manager and ask for it. Other apartment complexes, they pass them out to everybody, put them in their door and say, here's what you're going to need for your taxes this year. It depends on the level of service. You click begin, then it says, okay, renter's certificate of property. Now, I've never seen anybody come in with 1, 2, and 3. It's always just been 1. They bring in 1 certificate. I rent this apartment. Click begin. And then this is the form that is used. This is the Form 201 for Arizona. All of this information is on the page and it gets input into the software. Now, before we had to do paper files excuse me. And so all of this information was had to be entered by hand. Now we do it in the software and it sends it off electronically. The key part here is this is the property tax rate, the property tax factor. And that factor is reported as a decimal most of the time, 95% of the time. I have seen one or two where it came in as a whole number and I went, that can't be right. That's a hell of a lot of property tax. And so we had to call the property and find out, double check it. And they went, oh yeah, we made a mistake. We didn't put that in right. But almost all the time, you'll see it as a decimal. So here's where you start entering the information. Under the renter's certificate of property, you're going to do the landlord's first name, middle initial, last name. Then you want to do the address. So you come over here and click begin. You don't go on any of this stuff. You move over here, click begin, do it in order. Address, blah, 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 down to zip code, then save and back. Oh, look at this. Arizona's a little different. In the federal term, you always hit continue to save and move on to the next screen. In Arizona's return section, there are continue buttons every once in a while, but most of the time it's save and then you go back. So when you do that, it takes you back to the form you were at before where you had to put the business address in. When you hit back after that, it then takes you to the next part, the property tax factor, where you're going to enter that decimal number, but you're going to enter it by moving the decimal point 2 places to the right. Someday, I hope, TaxSlayer will have figured out a way to code this so that it does it for us. I hate to be manual. I'd rather have the software do it for us. After they've done that, we put in the signing party's first name, last name, signature date, their phone number, and the total rent paid. Here, you might run into a calculation to work out with the client. The client may have put in the total rent paid, or they may simply tell you, I pay $419 every month. Well, then you're going to have to do the multiplication times 12 to come up with an annual amount. Then you go save and back. And that brings you back to the main menu for taxes from Form 201. So you have to click back to back out of that one. Now we're back on the property tax schedule. And let's see, let me back up for a second. Okay. So in this particular case, when I was inputting the information, before I got to the Arizona property tax credit, this person had a $50 refund amount. They were getting a $25 excise tax credit for themselves and a $25 excise tax credit for their dependent. So that's all they were getting on their Arizona return, $50. So I plugged in this information for their rental property. And then when I hit the back button, the software recalculated and said, yeah, they get a property tax credit. And because of the property tax credit, their refund is now $138. It happens that fast. You hit the button and the calculation is made. So you hit back once again, and you're back to the main Arizona return. And then you click Exit Arizona Return. Then it shows you your 1040, your summary print page. And if you want to see Arizona, because this is for federal, it doesn't show you Arizona return. You have to go up to View Print Return and create a PDF file. Then this screen pops up, print your return. And I always think, oh man, I hate to waste all that paper. No, it creates a PDF file. It should say, create a PDF file. When you do that, this comes up. And up here at the top, it tells you how many pages there are in the return. Over here, it tells you where if you want to print it. Down here, you get to enlarge it or reduce it, the size on your display. So, you know, when I'm working with a client who's sitting beside me, which is back in the olden days before COVID, I would hit the plus sign a couple times to make the print larger so that they could see everything on the page as we scroll through the return. So then we get down, we scroll all the way through it, and it goes all the way down to page 16 is the front page of the Arizona Form 140. And on page 17, it actually shows us up here, there are $50 for your excise tax credit, and her property tax credit was $88. And that's why we came up with $138 for the refund. So over here on line 56 and 57, you get the increased excise tax credit and the property tax credit. And I'll tell you, there's one other one that kind of bugs the tar out of me. There's a family income tax credit. The family income tax credit is $80. It's a non-refundable credit. Do you get to use it if your tax is $0? No. If your tax was $79, do you get to use it? Yeah, it'll lower it to $0 and you'll give up the other dollar. If your tax is $0, you'd lose it. And so many of our people who get an Arizona property tax credit, they'll see this and they'll say, how come I don't get that? And we have to tell them it's non-refundable. You didn't have any tax owed, so you can't use this. It's non-refundable. Whereas these are refundable credits. And people living on Social Security, this is money they count on. And that's why they're there the first day. The family income tax credit is a non-refundable credit. It's $40 per person, and it's for dependent exemptions. You can't exceed $240 for married filing jointly. Well, what does that mean? $40 a person for $240? Let's see, what's that, 6 people? That's it. So if you have a family bigger than 6, you're out of luck. The excise tax credit is $25 for each person, but not more than 100. You're only good for 4 people. And you can't have been in jail for more than 60 days during the year. And you have to have a valid Social Security number or ITIN number. Now, I have never asked a client, well, have you been in jail this past year? I just plug the information in, and that's what happens. All right, that's the property tax credit, the family income tax credit, and the excise tax credit.
Hey, Gene, can we stop here for a second? Because there were a few questions and somebody said, hey, can we go over this all again? That was pretty confusing. And first, I'm going to say, yes, it is very confusing. And until you do a couple or 3 of these, you don't really get it down pat. And so we're not going to go over everything, but let me summarize the big points. And when you get to one of these, you'll get somebody to help you. After you do a couple of them, then it becomes a lot simpler. But here are the big points to remember. It's really for low-income people. And I forget what the actual threshold of income was, but it's what, 7,000 or 8,000 or something like that. I mean, it's low income. However, Social Security doesn't count. That's why most of the people we see, they're living on Social Security, or maybe they've got a little bit of other income, but there are a lot of those people and they know about this. Another thing I want to point out, you saw later on in the presentation, this is, even though they call it the property tax credit, it's for whether you own or whether you rent. Because if you're renting, the owner of that property is paying the property tax credit, but you're actually paying it. You're paying the owner rent, and he's using your rent money to pay the property tax. So that's why you have that Form 201. But those are the things to look for. Are they really low income, or Social Security their only income? Are they over 65? The other caveat, and we kind of went over it quick, but you've got to look at other people who live in the household. So maybe your mom or dad lives with you. They go in to file their tax return, right? And they're thinking, oh, okay, can I get this property tax credit? Maybe they even own the house. I don't know. But you have to look at other income in the household too. And that could disqualify them easy. Those are the big things to know. And the actual, okay, and then here's the other thing I want to tell you is we give you copies of these slides. So And you can't even practice this right now because Arizona doesn't, they're not in the practice lab, right? But you could go through these slides. We showed you exactly where to get all of that information and put it in. But I'm going to tell you, when you hit the first one of these, get somebody at the site or your site coordinator who has some experience. And after you do a couple of them, it starts to make sense to you. Okay?
Jim caused me to remember something else that's not on any of the slides. But one of the things that I ran into some problems with has been people who come in, they live in a trailer park. And we always ask them, are you paying rent on the space where your trailer is parked? Or are you living in a trailer that the trailer park owns and you're renting the trailer? And it makes a difference in terms of what the parcel codes are. And so occasionally we run into a client who doesn't know that. But once we figured it out, we try and make sure the client's educated so that they know it in the future for the future years. And I've had a few come in and say, oh, yeah, I live in a trailer park and this is my 201 because this is the land that I'm renting. I own my own trailer. I'm not paying property tax on it, but I am paying it on the land that I rent from them. Oh, okay, fine. We'll plug that in. So that's one of the kind of issues. Remember, none of this is being asked of you on the advanced certification test. The advanced certification test is all federal taxes, but you'll run into this when you get to Arizona. We have about 10 minutes left, and I think we're at the end of this section. I can probably do Native American stuff for Arizona in those last 10 minutes. Shall I try, Jim?
You bet. That'll leave us more time to do one-on-one instruction this afternoon if we need to.
Okay. Arizona has a lot of Native Americans living in it. You may see some of these at your VITA sites, and there are a couple of considerations that we want to consider. If an Arizona Indian, Native American, lives and works on the reservation, they get their income from reservation sources only, and they're a member of the tribe for which that reservation was established, we don't tax their income. Now, they're part of the United States, so they pay their federal taxes, but Arizona Native American tribes are considered a sovereign nation. And so the state of Arizona has to reach an agreement with them. And part of I think it was the Indian Gaming Act that created the casinos. Part of that was we would exclude their income if they met these three conditions. So if interest and dividend income is received, it's not included in Arizona income, even if the bank or corporation making those payments is located off. But the Native American has to live on the reservation and be an affiliated member of the tribe for which the reservation was established. Now, gambling winnings are not included in Arizona income if the casino is on the tribal member's reservation, the tribe owns the casino, the tribal member lives on the reservation, and the tribal member is the affiliated member of the tribe. If those conditions are met, their gambling winnings are not included in Arizona income. Native American tribes also provide a per capita payment. So if the Salt River Indian community, Salt River Indian tribe, has a casino out east of Pima Road, and they make $5 million in 2021 off of that casino. They then take that $5 million and they send out a check to every Native American who is a member of the Salt River Pima Indian tribe that lives on the reservation. They all get a check, a per capita payment. It's just like the oil company that has an oil pipeline through Alaska, from up at the top of Alaska in the Bering Sea, and they send the oil all the way down south to a port where it's offloaded onto ships. That oil company pays a per capita payment to every Alaskan citizen every year based on their profit sharing plan. So per capita payments received by Native Americans living off the reservation are taxable. If they're received by dependents who are off the reservation temporarily, like a student, they're not included in income if the dependent's parents live on the reservation and the parents are affiliated members of the tribe and the dependent's home is located on that reservation. Again, you're living and working on the reservation and you're an affiliated member of that reservation. So that per capita payment is reported on a 1099 miscellaneous, box 3, other income. If you see that, our question is, what type of income was it? Most of the time they say per cap, or they might say gaming per cap. In other words, it came from the casino. It's unearned income. And if we make sure that that's entered that way, then they're not eligible for the earned income credit. They didn't work to earn that. On the 1040 federal return, it goes in under Schedule 1, line 8Z as other income. Indian gaming proceeds is normally what we type in, but you could put in Native American distribution or Indian tribal distribution, etc. Native Americans who live on the reservation are affiliated members of the tribe for which the reservation was established are not eligible for the refund, to file for the refundable Arizona excise tax credit. You know, it's that big tax credit of $25 a head for 4 people.
Hey, can I just, you're going to get people asking, well, what is this? And I'm going to give you about a half an answer here, because my memory says it's back when they did something with the sales tax on groceries.
Oh, yeah.
They did something, I forget exactly what, but the simple answer is it's sort of like a rebate of your sales taxes for lower income people.
They were saying that the sales tax really affects low income people more than higher income people. And the effect is greater on them. And so the state said, well, we're going to attempt to ameliorate that. We're going to give them a little bit of a rebate, a credit, the Arizona excise tax credit, but it's really small and it's for very few people. Okay, where are we going here? All right. Okay, if the Native American worked on and off the reservation in the same year, you have to make an allocation to determine the correct excludable amount. If the Native American would have some excludable income, if the tribal member lives on the reservation, or if she's an affiliated member, you know what? This is too complicated. We refer these people to the Arizona Department of Revenue. They will help determine the excludable income as needed.
And actually, I would tell folks, I'm one of those site coordinators where I run a site on Indian reservations. I've got 2 of them. And it depends on the site. Sometimes the site coordinator is comfortable enough with doing that allocation. But so first talk to your site coordinator. But sometimes it gets really complicated, like when you're going to see in the next couple slides where we get. But you know, if it's a simple thing, they just had 2 jobs, and it's clear cut how much was off the reservation and on, we can create a spreadsheet and do the allocation for them.
Yeah, one of the samples I had that I used to give to new volunteers to help them train, they had to do a return where a gal lives on the reservation. She's a member of the tribe, and she worked part of the year for the casino, and then she got a job working at Dillard's in Scottsdale. Well, Dillard's in Scottsdale is not on the reservation. Well, she had 2 W-2s. It makes it real easy to exclude the W-2 that came off of the working in the casino, but it can be a lot more complicated than that. So our answer is always check with your site coordinator. Site coordinator can always refer them to the Arizona Department of Revenue. Now, if you're filing a joint income tax return, then you have to subtract the income in determining the Arizona adjusted gross income. So if you have the income earned by the affiliated Native American from the reservation, then you have the non-Indian's spouse or the non-affiliated Indian spouse's community income. You have to take 1/2. Again, that gets really complicated. And most of the ones that I have seen have simply been, and I've only, by most, I mean 4 or 5. Most of them come in and they live on their reservation, they work on the reservation, they are a member of the tribe of that reservation, and that's it.
And you know, when you get that one that comes in, you don't even file the Arizona income tax return.
Oh, really?
Yeah, they're not required to file.
Oh, cool.
It's only when you got partially that's taxable to Arizona, you know, where you have to do that allocation. Yeah.
Yeah, Arizona wants their partial.
Right.
So here's the screen that we used up before where we excluded the amount for government service. And here's the screen where we excluded the uniform services pension, all of it. Down here at the bottom, certain wages of American Indians. The amount that's to be excluded is entered into the box. And that's the only thing we do. So we had this slide. The only reason I wanted to put this in, we're telling the members of the tribe things that they need to bring in. The thing that I want you to remember is when you ask them, do you belong to the Navajo tribe? Do you belong to the Hopi tribe? Do you belong to the Tohono O'odham tribe? It's self-attestation. We don't need to see a tribal membership card. It's just if they say they are, then that's the end of it. So these are the three questions you want to ask time and time again if you deal with this. Are you a member of the federally recognized Indian tribe? Do you live on your tribe's reservation? And do you work on your tribe's reservation? Those conditions, if met, can mean that your income gets excluded from Arizona. And let's go back. Here we go. We've included a map of the Arizona tribes. We ask that you become familiar with the communities and towns located. If you're working in Scottsdale, there's a reservation just to the east of you. There's a reservation just to the south of Phoenix. So you have sometimes a client will come in and they'll say, and you'll want to double check their address. Here's the map. It's got all these tribal reservations around Arizona. Here's a list of all the tribes in Arizona. So it can be, I know there's a couple of sites that deal with more Native American issues. And so they do a large percentage of American Indian exclusions for Arizona. But where I volunteer at, over 8 years, I think I've seen 4 or 5. So that's really the concerns we have about Native American Indians, Native Americans with Arizona state taxes. And guess what? I made it. It's 12 o'clock. Yeah. Let's take a break and we'll stay here for a few minutes while you're, if you have some questions, and then we'll come back at 1 o'clock and we'll do the afternoon session.
I'm going to go grab just a quick bite of lunch for 30 minutes, and then I'll be back here at 12:30 so that I could help one-on-one if any of you need any other help too, okay?
Well, that sounds good. Let me do the same thing. Let's say we're going to be gone for at least the next 20 minutes, and then you can look for us to come back into the room, okay?
Okay, that sounds good.
It's lunchtime.
All right, thanks.